How to invest during a market crash. A recession-proof investment guide. When the markets crash, the panic and fear can be overwhelming. Investors often make the mistake of pulling their money out, locking in losses, and missing out on opportunities. However, savvy investors know that market crashes, while unnerving, can present a chance to reposition a portfolio and take advantage of long-term growth. In this guide, we will walk you through how to invest during a market crash, providing actionable strategies to help recession-proof your investments and weather any economic downturn. Understand the market cycle. Before diving into strategies, it's essential to understand the market cycle. A market crash is typically a rapid decline in asset prices, often triggered by fear or a significant economic shock. While market crashes can feel dramatic, they are usually part of a larger cycle that includes periods of recovery and growth. Historically, the market has always bounced back from crashes, though it may take time. When you're in the middle of a crash, it's easy to get consumed by short-term volatility, but focusing on the long-term picture is crucial. Bear markets, a market downturn of 20% or more, often turn into bull markets, a market uptrend, over time. Being patient and sticking to a well-thought-out investment strategy is critical. 1. Stick to a diversified portfolio. One of the key principles of investing, especially during a market crash, is diversification. A diversified portfolio helps spread risk by including a range of assets, including stocks, bonds, commodities, and real estate. By diversifying your investments, you're less likely to experience significant losses if one sector or asset class underperforms. During a market crash, certain sectors tend to perform better than others. Defensive stocks, such as utilities, healthcare, and consumer staples, often outperform during downturns. These industries provide essential services, and demand for their products and services tends to remain steady, even in tough times. Conversely, cyclical sectors like travel, luxury goods, and technology may experience a harder hit. Additionally, consider diversifying across different asset classes. For example, adding bonds or dividend-paying stocks to your portfolio can offer more stability during turbulent times. 2. Focus on long-term growth. One of the best strategies for investing during a market crash is to focus on long-term growth. Short-term fluctuations are a natural part of the market, and panic selling will likely lock in your losses. Instead of reacting impulsively, take a long-term approach to investing. In times of economic uncertainty, the stock market tends to recover over time. By investing in companies with strong fundamentals, you are positioning yourself to benefit from long-term growth. Look for companies that have resilient business models, strong management, and a track record of performance during tough times. One of the best ways to take advantage of market crashes is to buy stocks of high-quality companies at a discount. When stock prices fall, it can present an opportunity to acquire shares in businesses with solid growth potential at lower valuations. By holding on to these investments through the recovery, you could benefit from significant capital appreciation as the market rebounds. 3. Invest in dollar-cost averaging. Dollar-cost averaging, DCA, is a strategy that involves investing a fixed amount of money at regular intervals, regardless of the asset's price. This approach reduces the impact of market volatility because it allows you to buy more shares when prices are low and fewer shares when prices are high. Over time, this can help lower your average cost per share, especially during a market crash. For example, if you're investing in an index fund or a particular stock, committing a set amount of money every month allows you to take advantage of lower prices during the downturn. You don't have to worry about timing the market, which can be challenging during volatile periods. This strategy is particularly effective during a market crash, as it ensures you stay invested while mitigating the risk of making large investments at the wrong time. By continuing to invest through a downturn, you are preparing to benefit when the market eventually recovers. 4. Consider defensive stocks and ETFs. While a market crash can have a widespread impact, certain stocks and exchange-traded funds, ETFs, are better equipped to withstand volatility. Defensive stocks, like those in the utility, healthcare, and consumer staple sectors, tend to perform better when the economy weakens because they offer essential products and services. Additionally, ETFs that focus on these sectors can provide diversified exposure to defensive stocks. These ETFs may provide a safer investment option during a recession, while still offering growth potential. Consider adding some of these ETFs to your portfolio to balance risk and reward. For example, the Consumer Staples Select Sector SPDR Fund, XLP, is an ETF that targets essential goods like food, beverages, and household products. Similarly, the Healthcare Select Sector SPDR Fund, XLV, focuses on the healthcare industry, which remains in demand regardless of economic conditions. 5. Look for bonds as safe haven investments. Bonds, particularly government bonds, are often viewed as safe haven investments during times of market volatility. U.S. Treasury bonds, for instance, are considered one of the safest investments because they are backed by the U.S. government. Bonds tend to perform well when stock markets are in decline, as investors move their money into safer assets. While bonds may offer lower returns than stocks, they can provide stability and help preserve capital during a market crash. For those looking for a balanced approach, a mix of stocks and bonds can provide both growth potential and risk management. Municipal bonds, corporate bonds, and international bonds can also diversify your bond holdings and help spread risk across different sectors and economies. 6. Avoid panic selling. One of the most common mistakes investors make during a market crash is panic selling. The fear of losing more money can lead to knee-jerk reactions, like selling off investments in a panic. However, this strategy often leads to realizing losses that could have been avoided if the investor had held onto their positions. If you sell during a downturn, you may miss out on the recovery that typically follows. Remember, markets tend to recover after crashes, and you don't want to lock in losses at the worst possible time. Instead of selling, focus on your long-term investment goals and reassess your strategy. Ask yourself if your investments still align with your risk tolerance, financial goals, and time horizon. 7. Stay informed and be prepared for future downturns. Finally, staying informed about the economy, market trends, and investment strategies is crucial during a market crash. Being prepared for future downturns can help you make smarter decisions when the next crisis arises. Maintain a diversified portfolio, regularly reassess your investment strategy, and have a plan for how to react during tough times. Having an emergency fund to weather personal financial setbacks can also allow you to stay invested without panic selling during a crash. Investing during a market crash can be challenging, but it also presents opportunities for long-term investors. By sticking to a diversified portfolio, focusing on long-term growth, and employing strategies like dollar-cost averaging and defensive stocks, you can recession-proof your investments and position yourself for future growth. Avoid panic selling, remain patient, and stay informed to navigate market crashes successfully. Let me know in the comments section below. What do you think of our video? If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. Thank you for watching.